Friday morning, when global markets open, $14 billion in forced selling will hit the precious metals complex. Not a rumor, not speculation, a mathematical certainty. Bloomberg Commodity Index must rebalance. $7 billion in gold, $7 billion in silver, 5 days of structural liquidation, no discretion, no technical analysis, just forced execution. Scotia Bank's warning is clear. 17% of silver's open interest, about to be dumped. But here's what they're not telling you. The paper market is about to divorce from physical reality, and if you don't understand the difference, Friday could either be your biggest mistake or your last chance at $70 silver. The clock is ticking. Welcome to Currency Archive. If you've spent decades watching markets, if you remember when financial news actually meant something, then you know the value of information that doesn't waste your time. We don't do clickbait here. We do strategic economic analysis, the kind that matters when real money is on the line. Now, if you appreciate this kind of straight talk briefing, the kind your broker won't give you, do me a favor, hit that subscribe button, not for us, but because the next 72 hours could redefine your portfolio positioning. And before we break down what's really happening, drop a comment below. Where are you watching from today? New York, London, Singapore? Let us know, because what happens Friday won't respect borders. Now, let's talk about what $14 billion in forced selling actually means. The silver market stood at a crossroads on Thursday evening. Traders around the world watched their screens with unusual intensity because they knew what was coming. Silver had just touched 82.75, nearly breaking its all-time record high. The kind of move that makes headlines, the kind that brings new investors rushing in. But then came the correction. By Thursday's close, silver had pulled back to $78. A normal profit-taking move, most analysts said, just healthy consolidation in a bull market. Except it wasn't just profit-taking. Something much larger was about to unfold, and very few people understood the mechanics behind it. Deep inside Scotia Bank's trading division, analysts had been running calculations for weeks. They were tracking something called the Bloomberg Commodity Index, known in trading circles simply as BCOM, and their findings were stark. The index needed to rebalance, not because of market sentiment, not because of economic forecasts, but because of mathematics. Cold, hard, non-negotiable mathematics. When an asset rises significantly over a year, an index holding that asset becomes overweight. The allocation exceeds its target percentage, and rules require correction. Silver had risen dramatically. Gold had climbed steadily, and now BCOM held too much of both. The solution was mechanical. They had to sell. Scotiabank's note laid out the numbers with precision. $7.1 billion in silver, $7 billion in gold, $14 billion in total notional selling pressure, all of it hitting the market over just 5 trading days. The selling would begin Thursday after the close, but the real impact would hit Friday morning, when global markets opened and the flood began. For silver specifically, the numbers were staggering. The forced selling represented roughly 17% of the entire open interest in March futures. This wasn't a gentle rebalancing. This was a structural liquidation event. Market veterans knew the difference immediately. There are 2 types of selling in financial markets: discretionary and non-discretionary. And this difference matters more than most investors realize. Discretionary selling happens when traders make decisions. They look at charts, they analyze indicators, they check RSI levels and moving averages. They consider whether the market has already priced in the news, whether the rumor is worth selling, whether the fact has already been bought. But non-discretionary selling follows no such logic. Index rebalancing is structural, algorithmic, emotionless. The traders executing these orders don't look at triangles. They don't care about support levels. They don't analyze whether silver looks overbought or oversold. They simply follow instructions. Sell 7.1 billion, execute over 5 days, complete the rebalancing. Done. This is why the event couldn't be priced in, even though everyone knew it was coming. Normally, when markets know about an upcoming event, they adjust prices in advance. Traders buy the rumor and sell the fact, or vice versa. The information gets absorbed into current prices, but forced selling doesn't work that way. The sellers aren't making strategic decisions. They're fulfilling requirements, meeting allocation targets, balancing books. Whether silver is at $70 or $80 or 68, the selling happens regardless. 7.1 billion must be sold. The index doesn't negotiate with market conditions. By Wednesday evening, rumors had already started circulating. Trading forums buzzed with speculation. A Zero Hedge article appeared behind a paywall. Is silver about to crash? The headline asked what 2 banks were forecasting. And traders who couldn't access the premium article scrambled to find the information elsewhere. Investment websites picked up the story. The details emerged piece by piece, and experienced traders began positioning themselves. Some prepared to sell ahead of the wave, others waited with cash, ready to buy whatever dip materialized. But here's what most of them missed. The critical detail buried in the technical analysis: BCOM doesn't hold physical silver bars. They don't store coins in vaults. They don't own bullion in secure facilities. They hold derivatives, paper contracts, futures positions, ETF shares, financial instruments that track silver's price, but aren't actually silver. And this distinction, this gap between paper and physical, was about to become very important. Because while BCOM prepared to dump $14 billion in paper, the physical market was telling a completely different story. A story of tightness, of shortages, of delivery delays, and premiums that refused to fall. The stage was set for Friday. But the real drama, the true market disruption, would play out in the space between two worlds, the world of paper derivatives and the world of actual metal. What happens when these two worlds diverge? Marcus Chen had been trading precious metals for 17 years. He thought he understood silver markets, until Thursday night proved him wrong. At 11:47 p.m., he sat in his home office in Toronto. Scanning through online dealer inventories, what he discovered made no sense. BCOM was about to dump $7 billion in silver. The price should crater Friday morning. Every trading model predicted it. Every analyst expected it. But the physical market wasn't cooperating. Chen clicked through SD Bullion's website. Their 100-ounce silver bar page loaded slowly, and then he saw it. Sold out, sold out, sold out. Red labels plastered across listing after listing. He scrolled down the page. More of the same. The few bars still available carried a different label. Pre-sale. Ships February 13th. He checked the date. It was January 9th. A 5-week delay for a commodity supposedly about to crash. Chen switched tabs to APMEX, then JM Bullion, then Money Metals. The pattern repeated everywhere. 0.999 fine silver. The standard for futures delivery, the exact grade that BCOM would be selling in paper form, was virtually unavailable in physical form. And where it was available, the premiums told an extraordinary story. A 100-ounce silver bar should trade near spot price, maybe $1 or $2 premium for fabrication, but dealers were charging $85 per ounce. When spot silver sat at $78, $7 over spot, nearly 9% premium, on a product that's supposed to track spot price exactly. This is where most investors get confused. They hear silver price and think it's one thing, one unified market with one price, but that's not how it works. There are actually two silver markets operating simultaneously, connected but not identical, and right now they were diverging. The paper market trades derivatives, contracts that represent silver, promises to deliver silver, financial instruments tied to silver's value, but not actual metal. When BCOM sells $7 billion in silver, they're selling these derivatives, electronic entries and trading systems, positions that can be created or destroyed, with nothing more than computer keystrokes. No trucks need to move, no vaults need to open, no bars need to change hands. It's pure financial engineering. The physical market operates differently. Real bars must be cast at refineries. Real coins must be struck at mints. Real metal must be transported in armored trucks, stored in actual vaults, insured and secured. And right now, the physical pipeline was stretched thin. Refineries were running 24/7 shifts, melting down 90% constitutional silver, old coins from before 1965, dimes, quarters, half dollars, turning them into 999 fine bars. But they couldn't keep up with demand. Mints were rationing allocations to dealers, dealers were implementing purchase limits, and delivery times kept extending. Chen understood the implication immediately. When paper silver crashes, Friday morning, when those $7 billion in derivatives hit the market, physical dealers won't drop their prices proportionally because they can't get inventory. Instead, something counterintuitive happens. Premiums expand. If spot drops from $78 to $70, dealers don't sell 100-ounce bars for $70. They sell them for $78 or $80 or whatever price keeps inventory moving. Without creating a stampede they can't fulfill. The premium simply grows from $7 to $15. The physical market insulates itself from the paper crash. This creates a strange paradox for investors. Silver stackers watching their portfolios, seeing their net worth on spreadsheets, might panic when spot drops 10%, but the actual value of their physical holdings remains largely unchanged. Walk into a coin shop with a tube of silver eagles, try to sell them at spot minus 10%. The dealer will laugh. He can't replace that inventory. His wholesaler is backordered 5 weeks. He'll pay you close to what he paid last week, regardless of what paper futures are doing. Chen noticed something else interesting. Constitutional silver, the old 90% coins, were trading differently than pure silver. He found Mercury dimes at spot, Washington quarters at spot, Walking Liberty halves at spot. No premium at all. This made sense when he thought about it. You can't deliver constitutional silver to futures exchanges. It's not pure enough. The Shanghai Gold Exchange won't accept it. The COMEX won't take it. It needs refining first. And refineries were too busy melting existing junk silver to take on more at premium prices. So constitutional silver became the orphan, trading at actual spot price, while 9.99 fine products commanded massive premiums. For smart stackers, this created an opportunity. If paper silver drops to $70 Friday, and constitutional silver drops with it, but 999 fine silver stays at 85, then junk silver becomes the buy of the year. Eventually refineries catch up. Eventually that 90% silver gets melted, turned into 999 fine bars, and suddenly your $70 purchase contains $85 worth of refined silver. Chen started calculating his order. How many bags of quarters could he afford if Friday morning brought the dip everyone expected? But the bigger picture disturbed him. This disconnect between paper and physical, this growing divergence, it couldn't last forever. At some point, one of two things happens. Either physical premiums collapse back to normal, which seems unlikely given supply constraints, or paper prices rise to meet physical reality, which means current spot prices are artificially suppressed. Chen looked at his trading screens again. Paper silver at $78, physical silver effectively at $85, a $7 gap that shouldn't exist in a properly functioning market. And Friday's forced selling was about to test that gap. Would it widen further, or would something break? Captain Jennifer Holbrook stood on the bridge of the USS Porter, watching through binoculars as her crew boarded the Russian tanker. 3 weeks they'd been chasing this vessel, the Artemis, flying Russian colors, carrying Venezuelan crude, heading somewhere it wasn't supposed to go, now 200 miles off the Atlantic coast. American sailors were taking control of a foreign-flagged commercial ship on the high seas, in what international maritime lawyers would call a significant precedent. Holbrook lowered her binoculars. She wasn't thinking about silver markets, but perhaps she should have been, because 8,000 miles away, in a Geneva trading room, Alexandre Rousseau was thinking about exactly that. Rousseau managed a $2 billion commodity fund, and he'd just watched the tanker seizure on Reuters. His immediate thought wasn't about oil, it was about safe havens. Pull up the gold chart, he told his analyst, then added, and cross-referenced military escalations. Going back how far? The analyst asked. Start with 2022, Ukraine invasion, and track every spike. The pattern was unmistakable. Every time geopolitical tension crossed a threshold, every time international norms got violated, capital flowed into precious metals, not immediately, but inevitably. The tanker seizure wasn't happening in isolation. That same morning, Iran's army chief had issued a statement warning of preemptive strikes against American positions in the region. The rhetoric was familiar. Threats and counter-threats, the kind that usually fizzle into nothing, except when they don't. Rousseau had seen this movie before. Act 1, economic pressure and sanctions. Act 2, inflammatory rhetoric from both sides. Act 3, limited military engagement. Act 4, temporary cooling off. But lately, Act 4 wasn't happening. The cooling off period kept getting shorter. The temperature kept rising, and eventually something would ignite that couldn't be contained. He pulled up another chart, one that few analysts were discussing. Oil to silver ratio. Currently, an ounce of silver costs $78. A barrel of West Texas intermediate crude cost $56. Silver was more expensive than oil. This was historically abnormal. Deeply abnormal. When was the last time this happened? Rousseau asked. His analyst scrolled through decades of data. Early 1980s, briefly in 2011, and now. And what happened next in those cases? Oil caught up, dramatically. Rousseau nodded slowly. Everyone was focused on whether silver would crash. Nobody was asking whether oil was about to explode. If Iran and Israel actually went to war, not a proxy war, not limited strikes, but sustained regional conflict, the Strait of Hormuz could close, 20% of global oil supply, gone overnight. WTI wouldn't stay at $56. It would hit 80, 90, maybe higher. And industrial silver demand, which everyone assumed would fall in a recession, was surprisingly inelastic. Solar panel factories weren't shutting down. AI data center construction wasn't stopping. Electric vehicle production might slow, but it wouldn't halt. Silver had become infrastructure, critical infrastructure. And infrastructure spending tends to be recession resistant, especially when governments are desperate to stimulate. Rousseau switched screens to the Federal Reserve data. The numbers were almost comical. if they weren't so serious. U.S. national debt, $38.58 trillion and accelerating. The debt to GDP ratio had crossed levels that historically triggered currency crises in smaller nations. But America wasn't a smaller nation. It was the reserve currency issuer, which meant it could print and print and print until the music stopped. That morning, the Labor Department had released new data, job openings in November, down to a 13-month low. The economy was cooling, exactly as the Fed intended. Except now they had a problem. Cool the economy too much, and you trigger recession. But you can't let recession happen. Not with this debt load, not with this political environment. So what do? You cut rates, you stimulate, you print. Rousseau pulled up the CME FedWatch tool. This tracker showed market expectations for future Federal Reserve rate decisions. Currently, the Fed funds rate sat at 350 to 375%. Markets were pricing in 2 rate cuts this year, 50 basis points total, landing at 3.0 to 3.25% by December 2026. Rousseau laughed out loud. His analyst looked over. 2 cuts, Rousseau said. They think 2 cuts will be enough. He started typing notes for his quarterly letter. The Fed would cut at least 4 times, probably 5, maybe 6, because the economic data would continue deteriorating, because geopolitical instability would demand stimulus, and because the Treasury market needed support. The Fed had already announced Treasury purchases. Starting in December, quantitative easing by another name, they'd dress it up as technical operations, liquidity management, market functioning support. But everyone knew what it really was: monetizing the debt, printing money to buy government bonds, the oldest trick in the monetary playbook. And once you start, you can't stop, because stopping means yields spike. And spiking yields on $38 trillion in debt mean fiscal catastrophe. Rousseau did the math quickly. Current silver price, $78. Current market expectations, 2 rate cuts. If he was right about 5 or 6 cuts, and if each cut historically added pressure for debasement hedges, then silver at $78 was pricing in, less than half the monetary expansion coming. Gold at $4,400 was similarly mispriced. The market was looking at Friday's forced selling and missing the forest for the trees. His phone buzzed. A message from his analyst. Iran just moved 3 destroyer groups, heading toward the Strait. U.S. Fifth Fleet shadowing them. Rousseau looked at his screens again. Silver consolidating in a triangle pattern. Oil sitting at $56. Gold holding $4,400. Everyone focused on Friday's rebalancing. Nobody calculating what happens if the Strait closes, if oil doubles, if the Fed cuts 6 times, if de-dollarization accelerates, if China moves on Taiwan while America's distracted, if any of these pressure points, these multiple converging factors, actually materialized. He opened his trading platform, started drafting orders, not for Friday morning, but for the aftermath, for the recovery, for the moment when markets realized that a $7 billion paper dump was nothing compared to the forces building beneath the surface. Rousseau had been trading commodities for 23 years. He'd seen crashes and rallies, bubbles and busts, but this felt different. Multiple pressure points, converging simultaneously, each one capable of moving markets, all of them active at once. The rebalancing was a distraction. The real story was what came after, when the macroeconomic reality could no longer be ignored. Dr. Sarah Mitchell had been studying precious metals charts for 32 years. She remembered when silver hit $50 in 1980. She was just starting her economics PhD at MIT, and everyone said it would never come back. They were right, for 40 years. Now, sitting in her Manhattan office, looking at her Bloomberg terminal, she was seeing something she never thought she'd witness. A pattern 40 years in the making, finally completing. She zoomed out on the silver chart, all the way back to 1980, the peak at $50, then the collapse, then decades of sideways drift, a low around $4 in the early 2000s, then the 2011 spike back to $49, another collapse, another decade of consolidation. But when you connected the lows, when you traced the arc of those bottoms, you saw something extraordinary, a cup, a massive 4-decade cup formation. And in 2024, silver had finally broken out. Technical analysts call it a cup and handle pattern. It's one of the most reliable continuation patterns. In all of technical analysis, when it appears on a daily chart, it's significant. When it appears on a weekly chart, it's powerful. When it appears on a 40-year monthly chart, it's generational. Dr. Mitchell had written 3 papers on this pattern. She'd presented it at conferences. Most academics dismissed it. Charts don't predict 40-year cycles, they said. That's astrology, not economics. But the pattern didn't care what academics thought. It was completing anyway. The handle had formed in 2024, a consolidation after the breakout, silver ranging between $50 and $60, building energy, testing resistance. Then in late 2024 and early 2025, the explosion came, 50 to 60, 60 to 70, 70 to 80, and briefly 83. Now everyone was worried about Friday's rebalancing, about a potential crash back to 70, or even 65. Dr. Mitchell wasn't worried at all. She pulled up a different chart. The gold to silver ratio. This measured how many ounces of silver you needed to buy 1 ounce of gold. In April 2025, that number had exceeded 100 ounces of silver to buy 1 ounce of gold. That was extreme, historically extreme. It meant silver was dramatically undervalued relative to its monetary cousin. But since April, the ratio had collapsed, 100 to 90, 90 to 80, 80 to 70. Now it sat below 60. Dr. Mitchell ran the regression analysis. The trend line was clear. This ratio was headed lower, much lower. Historically, it bottomed around 15 to 1. In times of monetary crisis, sometimes even lower. At current gold prices of $4,400, a 15 to 1 ratio would mean silver at nearly $300 per ounce. Even a conservative 40 to 1 ratio would put silver above $100, and the mathematical momentum suggested the ratio would continue compressing for at least another year, possibly longer. This meant something critical. Silver was outperforming gold and would likely continue to do so. Regardless of Friday's rebalancing event, a temporary dip from forced selling wouldn't change the structural relationship between the two metals. Dr. Mitchell switched to another analysis, one that made her colleagues particularly uncomfortable. The M2 money supply to silver price ratio. M2 measures the total money supply. All the dollars in circulation, bank deposits, cash, money market funds, everything. She set the chart to logarithmic scale to handle the massive numbers involved, and the picture was stark. The ratio was falling off a cliff, meaning silver was rising, but not nearly fast enough to keep pace with money creation, to match the 2011 ratio when silver hit $49. Current silver would need to exceed $100 because the money supply had more than doubled since then. But 2011 wasn't even the peak. The 1980 ratio was the real benchmark, when silver hit $50, but the money supply was a fraction of today's level. Dr. Mitchell did the calculation. To match the 1980 monetary ratio with today's M2 supply, silver would need to trade above $700 per ounce, $700. The number seemed absurd until you understood what it represented. It wasn't that silver was going to 700. It was that the dollar had been debased by that magnitude since 1980. Silver at $78 wasn't expensive. It was still catching up to 4 decades of monetary expansion. She pulled up her email, started drafting her weekly note to clients. These were high net worth individuals, family offices, small institutions, people who paid for strategic analysis, not day trading tips. Regarding Friday's anticipated volatility, she wrote, the forced selling from BCOM rebalancing represents a tactical event within a strategic bull market. She paused, choosing her words carefully. The $14 billion in notional selling pressure is significant on a 5-day time frame, but trivial against the structural forces driving precious metals higher. Dr. Mitchell listed those forces: monetary debasement accelerating globally, Federal Reserve trapped between inflation and recession, de-dollarization by BRICS nations, industrial demand for silver remaining inelastic, physical supply constraints in the delivery market, geopolitical instability requiring safe haven allocations, and most importantly, 40 years of pattern completion. A decline to $70, she continued, or even $65, would represent a 10-15% correction in an asset that has risen 100% in 12 months and 400% in 18 months. Such corrections are mathematically normal and historically healthy. She attached a chart showing the current consolidation. Silver had been trading in a triangle pattern for the past 3 weeks, bouncing between support and resistance. Friday's selling might break that triangle downward, but triangle breakouts often reverse, especially when driven by forced technical selling. Rather than fundamental deterioration, the RSI had cooled considerably, from overbought levels above 80 down to neutral territory around 50. This was exactly what you wanted to see. In a healthy bull market, consolidation that relieved overbought conditions without breaking the uptrend. Dr. Mitchell had never sold physical silver. She'd bought her first coins in 1985 when silver was around $6. She'd held through the 2011 spike held through the collapse afterward, held through the doldrums of 2015-2020, and she was still holding. Her cost basis was irrelevant now. What mattered was the destination, not the path. People asked her all the time, "When will you sell?" Her answer never changed. When the monetary system stabilizes, when debt levels decline, when governments stop printing, when the ratio to M2 normalizes. In other words, probably never. She finished her client note, added a final paragraph. For leveraged traders, Friday presents risk. For physical holders, Friday presents opportunity. For long-term strategists, Friday is noise. The structural case for triple-digit silver remains not only intact, but strengthening. She hit send, then leaned back in her chair. Outside her window, Manhattan glittered. Millions of people working, trading, buying and selling paper assets. Most of them had no idea what was really happening to the currency in their bank accounts. Dr. Mitchell looked at her silver position, coins in a vault, bars in secure storage, allocated and insured. The paper market could crash Friday. The spot price could drop 10%, even 15%, but her ounces weren't changing. Her position wasn't diminishing. Physical metal didn't care about forced index selling, and when the dust settled, when the 5-day rebalancing window closed, when BCOM's $7 billion had been absorbed, the structural forces would still be there, pushing silver higher toward $100, then beyond. She glanced at the clock. Thursday evening, less than 12 hours until markets opened. Less than 12 hours until the selling began. Somewhere, traders were panicking. Somewhere, algorithms were being adjusted. Somewhere, stop losses were being set. But 40 years of pattern completion doesn't reverse on 5 days of forced selling. The cup had formed. The handle had confirmed. The breakout had occurred. And Friday's volatility was just the market's way of shaking out those who didn't understand the difference between price and value. Dr. Mitchell closed her terminal. She'd seen enough crashes, enough volatility, enough panic to know that this too would pass. The bull case remained intact. The structural forces remained in place. And silver's journey toward triple digits was just beginning.